So we're very pleased to have Brian Moynihan here today as our special guest. Brian, as I mentioned earlier, is the chairman and CEO of Bank of America. This is an organization that I think most people know. It now is an organization with a market capitalization of about $329 billion, which is the 10th highest market capitalization of any company in the world. A company which now has revenues of about $88 billion. Last year had operating earnings of about $21 billion, now has about 208,000 employees. And it's a company which has about $1.3 trillion in deposits, $2.3 trillion in net assets, pretty impressive numbers. And Brian came to the bank through a number of mergers, and let me describe his background. Brian is a native of Ohio. He went to college at Brown, where he was co-captain of the rugby team. Majored in American history, not in finance or economics. He then went to Notre Dame Law School and came back to Providence to practice law, and then he joined Fleet Bank and then worked his way up. When Fleet merged with Bank Boston, he became the head of global wealth management, and then when Bank Boston was acquired by or merged with Bank of America, he ultimately became the head of commercial banking, investment banking, and among other things, wealth management, and ultimately became general counsel, and in 2010 became the CEO of the bank. So he's involved in a lot of philanthropic activities. He's on the Brown board and also been involved for the last 30 years with a school in Haiti. And he is somebody that I think has done a spectacular job in turning around the bank, because we'll talk through the problems you had at the bottom of the Great Recession. So let me ask you if you could explain how a bank that was started in 1904, known as the Bank of Italy in San Francisco, became the Bank of America. How did that actually happen?
Well, so the bank that is the legal entity that is the headquarters and capital, was the bank, was the Bank of North Carolina, which started about 130 years ago, and it was known as different names, but finally became known as Nations Bank. And then it did the deal with Bank of America, and they took the name, and it was sort of a merger of equals. The headquarters was in Charlotte, they took the name Bank of America, and the board was sort of mixed between the two companies, and that became the company that is now known as Bank of America, so we're headquartered in Charlotte. But as I always say, that if you think about the company as being a river, the North Carolina company is the main river, but all these companies have flowed into it, hundreds and hundreds and hundreds, including the oldest one being the Massachusetts Bank, which was from 1784, which is the oldest charter we have.
So today, your headquarters is in Charlotte, which some people would say is not the center of the financial world. So is there an advantage to being in Charlotte?
Well, there's an advantage because that's where our headquarters is, and we have 16,000 employees. And so, frankly, from certain businesses, people say you have to be in a money center, and those businesses are headquartered. So our global markets business, our investment banks in New York, we have 6,000 people in London, 12,000 people on the island of Manhattan. And so, but for the consumer business, it's you want to be in other places. So the consumer business or the commercial banking business and things like that, where you are is not, middle market banking, business banking is not as important. And so it's good. And Charlotte has a tremendous pool of talent in North Carolina, because if you think about the heritage of the First Union Wachovia and the Nations Bank, you had a lot of talented people, and we've been able to take advantage.
Right, but the headquarters in Charlotte, some people would say you have to spend a lot of time in New York, the financial headquarters, some people would say the United States, and you live in Wellesley, Massachusetts. So how do you spend a lot of time traveling?
Yeah, basically, you always say you spend half your time doing this, 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 and it ends up more than one. But I'd say in my office time, it's sort of half between New York and Charlotte, but where I am is not as important. It's actually where the people actually do the work are. So.
Okay, so let's talk about the Great Recession. Now, when the Great Recession began, let's say 2007, where were you? What part of the bank were you involved with?
At the first start of it, I was running wealth management, and then I ended up taking over the corporate investment bank in the fall of 07, because they reshuffled the management, and I took it over.
So Bank of America had, like all American banks, had lots of problems, and your stock went as low as 5. Right. Now it's about 6 times as high, so I hope you have a lot of stock options and so forth. But
no options, just
no
ownership.
Yeah. Okay. So when did you ever think that Bank of America could go under? Was there ever a chance that a bank like that could go under?
No, and so if you think about it most broadly, what happened? Between 2003 and 2009, our company had done 6 or 7 major acquisitions: Fleet Boston, U.S. Trust, Merrill, MB&A, Countrywide. And so you put all that together, 300,000 people came into the company, through those acquisitions, and then you hit the recession, and you can't think of a worse time to hit a recession when you're still putting all that together. And so, but what was behind all that was number 1 or 2, 3 market positions in all the businesses that had tremendous earnings power.
All right, during that period of time, 2 acquisitions were made. Let me ask you about those. One was Merrill Lynch.
Right.
It was said that Merrill was about to file for bankruptcy, some people said, yet you paid $50 billion for something that was about to go bankrupt. So was that a wise decision?
If you knew exactly what was going to happen the next day, you would have probably done a lot of things different in life. That would make our lives easier, right?
Right.
But the reality was, if you think about it from an operating basis, it was a tremendous transaction for our company. And from the putting together the businesses, it gave us the combination of corporate and investment banking combination we have is really 1, 2, 3 in the world, depending on which attribute you're looking at. The ability to have a capital markets, a big fixed income capital markets with an equity capital markets. The financial advisory team with U.S. Trust gives us the number 1 position. So an operating basis. From a share issuance, it was about 25% of the company at the time. And so the issue was, it was originally valued at 50. By the time we got there, the company's share price come down. So it caused some dilution, and the fact that it lost so much money in its last quarter, we had to issue shares to cover that up. We had to take 2 pieces of TARP. The first one everybody had taken, and we took theirs plus ours, plus we took an extra one in order to be able to complete the deal. That converted into 1 billion-ish of shares, or 500-600 million shares, and we're still getting out of that. And we're back to where we were from the start.
Okay. So Countrywide, some people would say, is among the worst acquisitions in the history of American finance.
Right.
Would you agree?
Is this supposed to be entertaining for you or me?
Well, I just wanted to get out the bad news before we get to the good news.
Right.
So you didn't make that acquisition.
I guess it's Lent. I'm going through my 40 days here, one day at a time.
But Countrywide, you spent a couple $1 billion buying it, and it wound up costing maybe $100 billion or something?
Well, one of the things that, and you've done a tremendous amount of deals in your life, you always have to remember, the purchase price is only part of the issue. The question is, what's the run rate, what can do on the other side? And so what happened in Countrywide is, the whole idea of putbacks of mortgages and rep and warranty and all this stuff that people didn't only know about now because it happened, it was still sort of a theoretical debate. Risk had passed. Well, when it came back at you, it was really 3 aspects. One was a pure cost of paying off the lawsuits and everything. The second was the brand damage. And the third was the operational cost. And people forget, we went from 10,000 people to 58,000 people plus 20,000 contractors working for us, all the way back down to 9,000 people from 2010 to now. And just think about going through all those people, and because we needed all the people to help people we modified 2 million mortgage loans. It was a lot of work. And so when people look at it, they say the putbacks, the lawsuits, that was really only about 1/3 of the cost. The rest of it was all the other stuff, and the brand damage done. So it was not a good deal for many of those things. We fixed it, and life goes on.
So at the time that we went through the Great Recession,
quite honestly, from the standpoint of the country, it was lucky that they ended up in the hands of somebody who could actually take the pounding we did and got through it. Because if we would have gone into bankruptcy, you'd have had, I don't know, 10, 12, probably 6 or 7 million mortgage holders that would have been involved in bankruptcy. It would have been a disaster, and that was what it would go.
So the Dodd-Frank legislation was passed during that time. Do you support any changes in the Dodd-Frank legislation? You think it should be modified?
Well, I think with anything that happens, you swing a pendulum, and the idea is to get it back to the middle. So most of us, the large banks and the industry groups we have working on, are trying to say, let's get this thing back in the middle a little bit. And so, but we need the liquidity, capital, stress testing, resolution regimes. All these things are very important things that came out of it that we don't want touched. Because what is not well understood in American society is the FDIC is a government guarantee for deposits, but the FDIC gets filled up by the banking system. So the large banks have the highest interest in getting the regime right. And so the idea is, but do you need 10.5% capital or 9.5? And you'd say, well, that doesn't sound like a lot, 100 basis points, 1%. For us, we could make $160 billion more loans if you said 9.5 versus 10.5. Right. And so the question is, how do you balance it? So Dodd-Frank is fine. None of us are trying to touch it.
You're not trying to change it.
What we're trying to say
is, what about the Volcker Rule?
The Volcker Rule.
Would you be upset if it was changed, or?
The Volcker Rule, the problem is I don't think it does what we were after. It does what we're after, but it does the amount of work that goes into proving that you didn't do what proprietary trading is probably overworked now, and the regulators agree with that, and they're trying to figure out how to fix it, but the jurisdiction's in the hands of 6 different agencies. It's hard to get it, figure it all out, but the reality is the principal trading that went on in the, the Lehmans and the Bear Stearns and people that really got in trouble, it can't go on anymore, and that's a good thing.
Okay. So let's talk about the bank itself now. There are 4 major banks in the United States. The largest right now is J.P. Morgan. You're the second largest, second most profitable. Wells Fargo and Citi.
Right.
Do you think the United States should have more than 4 big banks? I mean, it's a big country. 4 banks enough? And is there too much power just in 4 banks?
I think a couple things. One is the top 5 banks have about 30% of the retail share, which is actually less consolidated than most other countries in the world by a lot. And so the reality is we have a big economy. So at 10, 12% market share in retail banking, we're big because our economy is big. It's not because we're outsized relative to our economy. What other countries found out is when their banks become much bigger than their economy, then you have a problem if things go wrong. And so our country's in good shape. That's the first point. The second point is we'll always have all kinds of banks, just like we have Home Depot and the local hardware store, Walgreens, CVS, the local drugstore, Marriott, Arnie's right there, in the local hotel chain or even the local hotel. You always have different ways to attack the market, major hospital chains and individual doctors and everything in between. And so it'll be a very diverse market.
Right.
We think that big banks can provide service and capabilities that a company like yours needs or to go around the world and do things that can't be done with trying to string together a bunch of small banks. And on the other hand, small banks have some attributes people like, and that's fine too.
Let's talk about consumer banking, which is basically people depositing the money.
Right.
You have, I think if I recall, roughly 4,500 branches in the United States and about 16,000 ATMs. Right. So is that a very profitable business, having branches? I mean, is that all that physical plant, you still need that?
Yeah, we do, because as much as people talk about digital and mobile and everything else, at the same time 1 million people, or 800,000 people come into our branches every day. And the teammates there have to do a spectacular job with them. And it's still 70% of the sales go on face-to-face, 30% go on digital. Up from 0 10, 15 years ago, but still you got 70%. And so the idea is you have to be expert at both, what we call high touch, high tech. You have to be an expert at both. So what you couldn't do is deny the trend of digitization. You had to disrupt your own company. So we have 34 million digital customers, of which 25 million are mobile customers, which do half our payments are digital today. But on the other hand, we have 4,500 branches. As I was telling you earlier, about $450 million in cash goes out every day out of the ATMs. The teller hands it to people taking out deposits, cash. And everybody says, I don't carry cash. Well, $450 million goes out of our company every day. To the retail client. And so you start to think about it, you need all things. And that's, so you need all things. The branches are critically important, but on the other hand, you had to disrupt yourself at the same time.
Well, I got some of it right here. I got
There
some
you
of
go.
the cash right here to put out today. Right now,
You're going to do the Oprah Winfrey, everybody's going to get $100
So
here?
maybe. So tell me this. Right now, you have about $665 billion of consumer deposits. You pay about roughly 0.4% on that, and you lend it out at roughly 4%, 5% ultimately. So that's a pretty good business, right?
Except half of that is non-interest bearing because it's checking accounts and people write 20 checks and come to the branches and do all that stuff. So there's an operating business between those two calculations that
So
takes you
it's
some
not,
money.
right. So what happens? Do a lot of people keep money and get no interest? Is that your best business, as people give you money and they don't want any interest?
Well, it depends on, all our businesses actually perform pretty well and the team does a great job. And so what we try to do is provide, we're one of the few companies that goes from, every consumer that's 10 years old has opened their first bank account through the wealthiest people. And so the idea is you have products and services designed against them. And we make a fair return for the shareholders, but we do a hell of a lot for the consumers and the communities we serve too.
All right, so let's talk about the ATMs for a moment. People use those a lot. And do you make a lot of money charging fees to people on ATMs? Is that a big business?
Not really. I mean, it's a part of what we do, but it's really, so why do we have the ATMs? Our customers need access to their cash, what I said before. B, it's a more effective way for people to deposit. So half the checks are deposited Bank of America on a given day, are deposited at the ATM. It's just simple for them than have to go to the teller. They can go, and the machines are all over the place, and there's more of them, obviously, than we have branches.
Well, your branches, though, the average person using the branches, they're probably closer to my age than 25-year-old people?
The cohort would skew a little bit like that, but not as much as you think. The reason why people go to branches, they have a more difficult issue. So yes, there's an age cohort that might feel more comfortable, but there's a different cohort. If you need a power of attorney because your mother's sick because you need to do something, you need to go talk to somebody to do that. Or if you want to get a mortgage loan for your first one, you tend to go talk to people to do that. Or if you want to get your first credit card, or you tend to talk to people to do that. So it has less to do with age, it has more to do with purpose of the transaction, of the interaction.
On credit cards, so that's a big business for you,
Yep.
I assume. So do you ever use your credit card and it doesn't work, where they deny you?
It happens. It hasn't happened in a while, but one of the only times it ever happens to me is I'm traveling someplace and forgot to tell people I was going there, and then.
And you don't call up and say you're the CEO of the bank, and that doesn't work.
They wouldn't. They wouldn't behave any differently than they should behave for all
really?
our customers. So.
Okay. So let's talk about your own background for a moment.
Because nobody knows it's me. You got to remember, there's a lot of people out there. If you ever get an email from me that I'm going to give you $10 million, it probably isn't right. So,
Okay.
but there's a lot of them go on every day.
So your background, you grew up in a family where there were 8 children.
Yep.
And so you were the 6th of 8. So when you came along, your parents were still very interested in raising you and paying attention to you, right? So how did you happen to go to Brown? You were in Ohio. Brown's a great school, but was there a reason you went there?
Well, my older brother had gone there, and he was interested in biology, and Brown had a tremendous biology program. So he went there, and then I applied to 4 or 5 schools. It was the best one I got onto, and I went there. I'd never seen it before I got there. It was just because it was a good school, and I went there, and I was lucky that it really, for a kid that growing up in southern Ohio in a small town, 18,000 people, but with, they had a little college there called Marietta College, and it was a very sort of interesting town for a little town in the middle of Ohio, in the southern part of Ohio. But Brown opened your eyes, and that's why I give it my time now. I met my wife there, my 2 kids have gone there, my brother went there, my other brother went there. None of us had touched the school before that, but it's become important just because I really appreciate what they do.
Of the schools you didn't get into, do you ever remind these people that they could have had the CEO of Bank of America as one of their alums?
Well, if I was sitting maybe with the former chair of the Duke board, I might be able to remind him of that. So. By the way, my lead independent director is the current chair. So.
Well, if we didn't admit you, it was our big mistake. But anyway, so. All right, so you went to, after you graduated.
I think they waitlisted me, actually. I don't really remember, but that's.
But you're playing rugby.
Yeah.
Rugby is a tough sport, and you were a star at that. You were the captain of the team, co-captain. So did you ever consider professional rugby, or you weren't that good?
Oh, God, no. I played till I was 31, so I played for club teams after. So I played at Brown, I played at Notre Dame, I played for a number of years after. It was a tremendous experience. The game is so much more professional in the United States now than it was then, because most of the clubs started sort of in the late 50s, early 60s. So think about when I played in the late 70s, they were not as advanced.
So you don't break a lot of bones playing that game?
I never got hurt that badly, and that's why I quit. When I got to the point where my skills, because I was working and I just couldn't keep up with the kids that were bigger, stronger, faster, and had more time to think about that than I.
So there are not a lot of Rubensteins playing rugby. Probably you didn't run into a lot of Rubensteins.
We had a very.
Really?
I was with the mayor of Orlando, a guy named Buddy Dyer, the other day. We were on the rugby team together, and so I showed a picture of us winning a championship in the Ivies in '79, and it reflected the Brown community, and as you know, Brown.
All right. So you went to law school at Notre Dame.
Yep.
And you wanted to practice law. So why did you go back? Why did you decide to go back to Providence? You just fell in love with Providence when you were at Brown?
Well, as I said, I met my wife at Brown, and she was on the East Coast, so I was trying to get back there. And nobody in Boston had ever hired anybody from Notre Dame at that point. And so I went to the Boston firms and couldn't get in. And I do remind, because the captain of the rugby team 2 years before me is a partner at Goodwin Proctor, I remind him of that a lot. And he reminds the others that. But I could get hired in Providence. I was the first person who was ever hired from Notre Dame Law School at this firm.
Right, so you're practicing law, and like me, you came to the conclusion that it's not maybe as good a thing as being on the other side, being a business person, maybe. So how did you actually get out of the practice of law?
In 1991 or something, Fleet did a deal where they bought the Bank of New England out of the FDIC in the late real estate crisis in the late 80s and early 90s. And a fellow named Terry Murray, who was running Fleet at the time, went to the general counsel and said, I helped structure that transaction. It was kind of a wild transaction, had dual convertible preferred stock, had stuff that, and he said that Bill Mutterpearl, who was one of my mentors, and Duncan Johnson was the other lawyer that was very important to me. He said to Bill, "This guy's too smart to be a lawyer. Why don't you get him in here?" Which I always thought was an interesting thing to say to the general counsel, and I'm not sure it was true because Bill was very smart. But I'd never really practiced law at Fleet. I went on a project where we re-engineered the company, and then became the head of M&A. And so it was really, I was lucky because Terry saw something and said, "Come do it," and I could take the risk because I didn't have to go out there and see if I could get a job. I could take the risk of moving over with someone who knew me and knew my skills and was going to be flexible to figure out what I could do. Because I practiced law and done it well, I think. But what I hadn't done is ever managed people or managed a company or driven people through an integration or re-engineered the company. And so they quickly started throwing me on this stuff. And it was pretty good.
So you ever pinch yourself, say one day you're a lawyer in Providence, and the next day or a couple of days later, you're the CEO of the Bank of America?
That's why you have kids. They remind you of that you're not what you think you are. So they're pretty good at it. So
what do your siblings say? You wind up as a CEO of Bank of America. They're pretty impressed, or they don't treat you differently?
So when people ask me sort of how you did this, and I often get, and you probably get this too, David, you get a young lawyer that says, "I want to do what you did." And I always say, "So what steps do I have to take? How do I plan that out?" I said, "Well, if you start trying to plan it out, it's never going to happen. So you just have to take the opportunities that exist." So I had to make the leap from, I was a partner in a law firm. I was making decent money. I had, at that point, almost 2 kids, and I had to make the leap that I could be successful. And that's what I always tell kids, is just take the leap, but make sure you understand the people you're doing it with, because at the end of the day, that's what's going to make you successful. Is if the people have an interest in you and you like them. You don't have to be their most social friend, but you have to like them well enough and you have to understand them, and then you can go on. But you can't plan your career. So I do pinch myself saying, "How did you get from here to there?" You always say that, and I've been very, very lucky. But you have to, Jim Collins writes the books, and he always talks about the return on luck. At some point, you had to get the return on luck.
So let me ask you, now we're in Washington. When you're in Washington, presumably you're going to see legislators or regulators. Do you meet President Trump very much, or have you met him?
I've met him before he was in office. We work with the administration a lot, with whether it's Treasury, whether Gary Cohen and others, and all the agencies, and work very well with them.
So did Bank of America ever bank Donald Trump before?
We don't talk about clients.
You don't talk about, okay. All right. So would you have any interest in ever going to government when you're done with what you're doing now? If you've practiced law, if you've done things, you always think about it. But what I love about our company is we can have an impact on the communities through the work we do, on the teammates, because we employ 209,000 people, but we also provide health insurance for 400,000 or 500,000 directly and almost 1 million indirectly with the retirees and stuff, and how we work on wellness, or how we work on gender equality, or how we work on diversity. And to me, in some ways, you can almost have more impact, working on that stuff, because frustration of government, when you talk to people, is it's just hard to get things done. So the tax law that is now the law of the land that passed recently, is that helpful to the bank?
Sure. You have to step back and say, what do we need out of the tax law? And it got convoluted with all the stuff that's going on, as everything does. But the core thing you needed for the corporate America was you needed a territorial system and you needed a lower tax rate. And both those things are in there. And so it's good for everybody. It's good for us. We took a $3 billion charge in the fourth quarter for it, but it'll provide good earnings support going through. Our tax rate would be 31 to 21 type of numbers. Now, that's because we pay a lot of taxes. We get a benefit. So we were one of the largest taxpayers in the United States. And so the benefit we get is a portion of that back. But that's then causing us to invest. So far, 90% of our teammates, all but the top 10%, have received a direct benefit to the tune of about $400 million across all the teammates. We did a stock plan. We did the $1,000 bonus before year end. We just did it outside 9 states. We're going to step up our investment in the speed of opening these branches in cities we aren't in, which,
So you're happy with it?
Oh, we're happy with it. But it was the right thing for the United States, because what surprised me is, and you and I were in Davos together, and we did a couple things together, saw each other at various things, but if you talk to the CEOs of companies outside the United States, that was a surprising thing to me, because you could see why the U.S. companies were excited by it, because the statutory rate went down. But when you went to the companies outside the United States, they always believed the United States is a great place to do things, because great final demand. The U.S. consumer spends a ton of money and buys stuff. The best work rules and rule of law to operate in. Energy, plentiful, uninterruptible, low cost. And so all that was a great thing. But the problem was if you came here, if you took your motorcycle manufacturer, moved it here and sold it to the U.S. and captured it at 31, you're capturing someplace else at 12. That was a negative arbitrage, so they tend to try to make them and put them into the country. That's changed. And so, because now they're saying, if I get this income trapped in the United States, it's not trapped anymore because it's territorial, and it's not trapped because it's lower rate. And I think that's going to be a different feeling.
Right. Now, banks like when people borrow money, that's how you make money, but are you better off when interest rates go up so you can charge more, or are you more concerned when interest rates go up because it might lead to higher inflation, other problems?
Two things. From a standpoint of interest rates, the issue was when the rates fell, there's a zero floor, so we can't charge people interest. So we basically we ran into a zero floor. So the traditional spread between, say, treasury rates and the rates you paid on deposits went to nothing. And so we had to take our cost structure way down to get underneath that. So when that comes up a bit, that helps us out. And that's what a lot of talk about is rising interest rates help banks. And it has to do with your assets reprice. But the more important thing is your free deposits now are worth more because there's not a zero floor. That being aside, it's all a question of why is the rate structure moving. So people, right now the 10 years run around 290 or so. I had somebody look at it again because I hadn't looked at it in a while. But if you look at the 10 years since 1950s, which is zeros you can get on Bloomberg and stuff, it starts at around 3%. It goes up, stays up there, and kind of bounces around all over the place, and comes down. And the only two times it's ever been at this level was right in the early 50s, and now, and for the last 6 or 7 years. So these rate structures is tremendously low. So the Fed's trying to normalize it. And so if they normalize it and it all works right, it's spectacular.
So if the Fed were to increase interest rates a few times this year, you're okay?
If it's done, if we don't lose control of inflation, if we don't
have... And do you go to
the
the Fed and give them your advice about what they should do on interest rates?
I'm not sure they need it. But yes, they ask us about the economy, what we see. And what we see in the economy right now, if you think about it from our research team, so Candace Browning Platt and the team is one of the best research teams in the world. They basically have the United States at 2.7% GDP growth for 18. But you got to think about that. We went from 1.6 to 2.1, 2.2 to 2.7. Right. It's that increase that's causing economic activity. And so our view is the Fed should normalize rates into that growth, late cycle growth. But on the other hand, you hadn't seen a lot of inflation, and everybody's debating about it. But and our team thinks the U.S. is going to grow, and so the Fed should normalize. What they are doing has been clear to people. I think between Chairman Yellen all the way back to Chairman Bernanke and now Chairman Powell, they're telling you what they're going to do. It's not a big mystery. They're telling you exactly what they're going to do. Yeah.
Okay. Now, talk about cryptocurrencies. Yeah. Is that something that you're worried about, or you're happy about it?
Well, if you think about cryptocurrencies, there's 2 or 3 different concepts embedded in it. One of them is the concept of a distributed ledger, so-called, which is the idea of verified ownership interest in something that can be verified by anybody by one ownership interest. It sounds really sexy, but that's what the Registry of Deeds is, the Registry of Motor Vehicles is. It's a concept that's existed forever. The question is, when you do cross-border transactions, it's harder to figure out who owns stuff deep in the supply chain. So the way you do it is you rely on local banks to put LCs behind pieces going in the supply chain. If you get the blockchain technology, which is the first part of the question on what supports cryptocurrencies, that's tremendously interesting to change the amount of work it takes to verify ownership. So we have 40 patents on that already, and more than most people. The second thing is digitalization of money. We believe in that. So 53% of all the payments made in January 17 by Bank of America customers, or January 18, by Bank of America customers were made in digital form. Okay. And that doesn't include swiping your credit card at a Starbucks. That includes bill payment and wires and things. And so that's important. Anonymous currencies, that's a policy question that is very difficult.
Now, in your case, do you write checks still, or everything is digital?
Everybody does everything.
So you still write checks?
The number of checks in the United States continues to be is flattish right now in terms of checks written. It's hard to believe, but we probably have 8 or 9 million go through the system every day, if I remember right. And so I still write occasional checks. It's down a lot, but I pay most of my bills online. But there's still certain things you still write a check for. That's why we brought out Zelle in the banking industry to eliminate the need, for if I want to pay you for a lunch that I give you a check, I can basically Zelle it to you now. And we had 15 million Zelle transactions at Bank of America in the fourth quarter, growing at 100% per year, and it'll become meaningful. Just take a while.
Let's talk about the job you have. So how much of your time do you have to spend with government regulators, legislators? How much with employees? How much with customers?
it's a little bit, like I said before, half, 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 half. And I'd say that you try to balance it, and you do it more sort of programmatically. But I'd say it's probably half with external and half with internal, and with the board and the management team and figuring out what to do, and then also talking to the internal team. So we just had our senior leaders meeting, and you try to have an impact on customer side, but you always have to remember that at the end of the day, it's Jeff Wood and his talented teammates here in Washington. It's Michal Chamberlain in Boston. It's Charles Bowman in Charlotte. It's the teammates in the field that actually drive our company. And so the idea that I'm going to make an impact on customers when you have 50 million consumers and 30,000 middle market companies, would people be waiting for? You have to get everybody.
Do you ever
drive.
go to a branch?
Oh yeah.
And when you wait in line, or you get right to the front of the line? Or when you show up at a branch, they know who you are, I assume.
They do now, mostly.
Mostly? Okay.
There was a couple of times early on where you'd walk in and you get. I remember walking in a branch once in a place that we no longer have branches, where the person was reading a book, and I said, "How are you doing? I'm Brian Moynihan." And they said, "Hi, how are you doing?" And went back to reading a book, and it was kind of an
So
interesting.
is she still there, or is that person still employed?
We don't own that. We sold those branches to another place a long time ago. It had nothing to do with that. It just happened to be where they were.
So today, if I had some money and I wanted to go into a banking relationship with Bank of America, J.P. Morgan, Wells Fargo, or Citi, why would I want to go with you? Why are you better than the other three?
Well, we have the best. We have
Other than the best CEO,
the
right?
the best products, the best capability, best people delivered, and I think we have the way we come at the business is to figure out all aspects of what you need from us, and so. And we integrate them well. And so instead of our credit card rewards reward you because you're a customer across your bank account, your checking account, your savings account, your auto loan. And so we reward a relationship, I think, better than everybody else off the Bank of America relationship. And so the products are tremendous, the people are tremendous, but I think it's also the way we think about integrating the business for people. So you give us more, we give you more, and that's how we built the business across the last 10 years.
So when you're in Washington, you're dealing with legislators, members of Congress. Do they seem to understand your issues very much, or not so much?
Yeah, I mean, it depends. If you try to get the arcane questions of what the supplemental leverage ratio is, I don't think many people should bother to know it. But when you get into consumer banking, everybody has a view of it because they all have bank accounts. So they all have a view of what you have done right or wrong, and mortgages and other things. But usually our job with them is to inform, to make sure they understand the ramifications of some of the things that sound like do this, but then you don't understand the second, third order effects. So the idea of making credit available is great until you find out that they end up with an over-borrowed base of consumers in America and an over-lent base for the companies, the banks, and then you end up with a problem. The idea of changing the leverage rules for buyouts and push the banks away from anything was good until you found out the loans were just getting done by somebody you couldn't pay attention to. And who would you rather have doing that? JP, ourselves, and Citi, sort of setting the terms. Not the best for you because you have tough negotiation.
I assume your highest margin business is lending money to buyout firms, I assume, right?
No, we don't get paid at all for that. But,
really? Okay, all right. Today, what is the biggest challenge that Bank of America has? I mean, what are you most worried about?
At the end of the day, if you think about it from sort of the financial side, it's always the economy. At the end of the day, banks reflect the economy. Our job is to transmit our consumers and our companies to the markets, or to transmit them into the economy and help them engage in the economy. So if the economy is growing, we're going to be okay. If it's not growing, it's not so fun. And so because credit goes down when unemployment goes up, whatever. And so largely that's the thing we worry most about. And so since you can't control it, you just sit there and say, how do you be resilient if it happens? The flip side, from just a management perspective, we have to drive what we call responsible growth. So we have to grow no excuses, but do it with the right risk and the right customer focus and the right sustainability to it. And so if you think about that, the trick is to get people to realize you got to grow, but we got to stay within our risk appetite. And that is tough because in good times, the markets get a little overheated, the terms get a little too beneficial. And you got to tell people we can turn away business, it's okay. And that sounds like you're telling them not to grow, but you're actually telling them to grow responsibly, and that's a focus. And the third is complacency. We're doing well, we're making money. Market cap is up, like you said. So I show them other people's market caps that used to be that high, including ours. It came down, and you try to just put the fear of God in them so they keep going, they keep pressing.
You're doing well. A lot of times when you have a ubiquitous company like a bank, everybody has to have a banking relationship, or probably does have, relationship. Why is it that banks are not that popular?
Well, I think we are more popular than people say, but the reality is our customer scores we test in a way that no one else does, millions of people every month, and they're the highest they've ever been. They're not high, I want them higher. I want them to go to places we've never gone. And so the basic brand's in the best condition it's ever been. The consumer scores are strong. The wealth management scores are strong. The commercial banking scores are strong. And so the brand's in the best condition it's ever been. The question of the societal view of our industry is still shaped by what happened in 06, 07, 08, 09, because people forget the crisis really started in the fall of 06. And it really dealt with the industry, people over borrowing and the industry over lending, and then the ramifications of that. And the way to get through that is to get through another crisis where we aren't the actors. We're helping, and I think that will take good, sound regulation, which we have, and good behavior on the part of ourselves to keep ourselves out of the
So, if you're a young person graduating from college or business school, why should somebody want to go work at a big bank? What's the appeal of working at a big bank compared to so many other options that young employees have?
The appeal is strong. We're at record applications. We have 30-odd thousand people come in for the jobs in the summer and stuff. The appeal is, I always tell people, if you want to do this to make money, please go somewhere else. You have to do it to help people live their lives, financial lives. And if you come for that, it's a very good thing. And the industry owner really gets in trouble when they make it about our profit, how we make money, as opposed to how we help your company successfully buy a company and do 4 bolt-on acquisitions, or that consumer successfully, learn how to buy their first home or go to college or whatever it is. And that's what we say to people. So we're very popular. The second part of it is the way we run the company from sustainability to our firm means 3 things. The best place for our teammates to work, which is our wellness, our diversity, our leave practices, with giving back practices at the consumer level, 2 million volunteer hours, 200 million in philanthropy, diverse board, management team. You can do anything. We make it simple. We want everybody to come to work in our company with one simple statement. I can be anything I want to be, and I don't have to leave myself at the door. And so that's the teammate. Then you have what we call the ESG side, which is our environmental programs, or like today we just announced that our community development bank last year did $4.5 billion of financing, 12,000 housing units in low and moderate income neighborhoods, $3.5 billion of debt, $3.25 billion of debt, $1.25 billion of equity. And so that's why kids want to come here, because they have those things going on that are interesting. And then you get to do really fun stuff.
Let's talk about Europe for a moment. Now, you have announced that you're going to set up your corporate headquarters in Europe post-Brexit in Dublin.
Yep.
Now, is that because you're Irish? You had a predisposition to Dublin, or what was the reason?
The question was the path of least resistance, and the Irish government's been supportive of trying to get people to locate there. We had a bank in Dublin, and we had a bank in the UK, and so we could merge the UK bank into Dublin, and we don't have to go out and get a new charter. And so for the broker dealer, which is called a financial company there, something like that, we have to get that charter set up. And so it was sort of the quickest path. And we didn't have anything close. We had 800, 900,000 people in Dublin. We had a charter. We'd been the biggest bank before the crisis in Ireland, and they remembered that. Romero was, and we had to fix that for them. But and so it was natural. They have talented people. They're very accommodating to us getting set up there. We had 1,000 people to start with, or nearly 1,000 people. And we had a charter, and so we did it. And so I moved a fellow named Bruce Thompson over to run it and make sure it happens. But Brexit, we're spending hundreds of millions of dollars, and the customers are not going to get anything out of it. This is just an array of legal entities around. It's really tedious stuff, driven by the decision, which it's a decision, so we got to do it.
So you have a foundation that gives away a fair amount of money. How much money does the Bank of America Foundation give away a year?
It's about $200 million of direct philanthropic work, and about 2 million volunteer hours, and on top of that, the stuff we do in our development work is not direct charity, but it actually helps.
And what's the best way to get some of that money?
Everybody knows, believe me.
Just apply. Call
yeah,
you,
just
or
apply. We have a formal charitable group that looks at all the applications coming in under a fellow named Andrew Plepper and Ann Finucane and Kerry Sullivan, and they look at all of things. And we have certain programs, like I was talking to the person earlier, we have the Neighborhood Excellence programs, Neighborhood Builders programs, where we do grants for smaller nonprofits to grow their administrative side, which nobody likes to give to. They have to give to some program or building, but we do that. We do art restoration, as you know. We worked heavily with a new museum for African American history and culture. But it's Boys and Girls Clubs, it's Youth Build, it's City Year, it's Europe, it's all the programs, and so we spread it pretty wide. We largely focus on education, art for the democratizing art. Great program, Museums on Us, 200 museums around the country, free entry if you can show them your card. A tremendous program. The curators of those museums, the executives love it because it brings people in, and then we sponsor some of the great exhibits, and then we get the people to go see them. So it's fun stuff.
Now, are you worried about being marginalized, but some of your business being taken away by technology companies, fintech and other things like Google and Apple? They're doing a lot of things where they're kind of replacing banks in some things. Is that a problem for you?
It can't be a problem for us because we got to face it down and own it and drive it. And so, like I said earlier, we have 34, 35 million digital customers today, 24.5 million going to 25 million mobile customers today. They did 1.3 billion digital interactions the last quarter, up from 900 million a year ago, fourth quarter. So 1.3 billion digital interactions. And so we have to be as competent. We spent $1 billion in the mobile platform probably in the last 3 or 4 years. And so am I fearful of them? No. Do I learn from what they've done? The team does. Did the team learn from what they've done? Yes. Do we review it constantly, say, what are we missing? So a simple example is in the small business space, as you saw these online lenders come up, we realized we were taking 20 days to do the underwriting. We're not going to do it in 20 minutes because we don't think that's wise. But what if we did it in 2 days? So we were able to rearrange our processes for the smaller loans to do it faster, and that, our loans have been growing and fine, and we do, and we have more small business loans than I think anybody else does, and but it took us recognizing what was the appeal of those disruptors or fintech companies, and so we drive it. So the idea is we're not afraid of them, but on the other hand, you got to learn from them and drive it, and then you can't forget that the 3 or 4 major technology trends are going to shape a lot of what happens, and none of us know exactly what's going to happen. Voice recognition, artificial intelligence, data transmission, network power, the ability of networks to actually connect you, and data storage accuracy and transmission and artificial intelligence to manipulate it, and voice recognition to access it. You start thinking about this stuff. Our Erica platform on our mobile is out, and 40,000 teammates are using it now. It'll come out to the public soon, which you can basically say, transfer money to David, and it will transfer the money to David. That's all you have to say.
Now, let's suppose you want to buy a house and you want to put a mortgage on it. Who reviews your credit application at Bank of America? Does somebody review your? There's
rules on that called Reg O, so it's reviewed heavily. But
so you wouldn't borrow money from another bank, though?
I wouldn't borrow money from another bank because we have the best products. But there's some people forget there's been a lot of regulation around this industry for years. So every credit extension to any officer or director has to go through an extra one.
Now you're relatively young, 58 years old. Right. So you could do this for quite a long time, but do you intend to stay for 5 years, 10 years? And if you eventually leave, what will you like to do next?
I always say, as long as they'll have me, I'm having a great time doing this. I had a chance to sit with Mr. Buffett and interview him the other day. He looks like he's having the time of his life at 87. So what the hell? We can keep going.
Well, I want to thank you for coming today, and thank you for what you're doing.
Thank you.
I have a gift for you.